Hello everyone, May 2017 market update, Kevin Coyle, John Finley. John, we left off last time, post-election, some of the euphoria with anticipation of the positives from Trump policies, some areas of the market doing better than others. We've had a little bit of a change since the last month or so. The market leadership has kind of rotated from the value more toward the growth component. Some comments on that maybe to start.
Well, I think there still was some euphoria going into January that picked up from the growth side of the stock market, and we saw for the first quarter 40% of that coming from the usual four names, and those are growth large tech companies. And as we get past the first quarter, and it looks like we're looking now for earnings from companies, and we're getting a lot of surprises from first quarter earnings reports, including companies like GE, a couple of big banks, Caterpillar, McDonald's.
So those are the companies that initially were thinking would benefit from some of the Trump policies, and those stocks started to move. Then as the year started, concerns about growth rates truly being positive, you saw the growth companies that can grow their earnings in all environments, kind of take leadership. That really is what's leading the market right now with those tech names. But the earnings coming in are more in the value area as well. So it's kind of this mixed bag trying to get a handle on where the leadership's coming from. We're coming off of 3 years of largely stagnant earnings, right, which we talked about last time. And so we're seeing some positive signs in terms of earnings really happening, despite what the policies might be. Whatever can get through Congress remains to be seen. When you put all that together, you still kind of have this mixed bag of GDP growth, first quarter coming in below expectations, earnings expectations being higher than maybe what might be sustainable. What are we seeing there in terms of economic growth?
Yeah, mixed bag. Again, you can pick your poison, but at a high level, productivity growth is very slow and falling. Population growth in this country is slowing. Those are two drivers of real GDP over very long periods of time. I would also say bank lending, we're seeing weakening there, which has traditionally been a sign of a weakening economy. The bond market, so what's interest rates telling us? We're seeing a flattening curve as the Fed raises the very short end of the curve. 10 years stayed pretty much stationary, where it's been really the last 4 years in the trading range. Inflation is not an issue, and there are voices that are saying we ought to be looking for almost disinflation going forward. But we're not seeing from the bond market again a sign that the economy is expected to be very robust, because we would see higher interest rates in that case. And others might argue, though, that the Fed, because of quantitative easing all these years, has kept rates artificially low. There's some truth to that.
Well, coming back again, we're back to the $64,000 question, is earnings growth will need to continue to drive this thing going forward if stock market continues to get ahead of the earnings of underlying companies. Now, normally you see a recession when you have rising interest rates, peak earnings, excesses, demand, credit growth. We're not really seeing that so much, which was normally when you have a recession, you're going to see a 20% decline in the stock market or more. But when you have periods of time like this with uncertainty and you have expectations kind of get missed, that's when you can see a 5, 10, 15% decline in the market as well, which could happen at any time.
Right. So there's got to be earnings driven at this point, and whatever Mr. Trump can get through Congress in terms of tax cuts will help. I don't know about infrastructure spending won't happen this year, but that'll be another component as government spending is a part of GDP growth as well.
Well, mixed bag, uncertainty, some positives, some things to be concerned with because the debt's still out there. There's $20 trillion of debt. We're running $500 billion to $1 trillion budget deficits. Those problems are not going to be solved overnight. But then again, you know, yesterday is a fond memory, today is a grand opportunity, right? As we move forward, you know, you look at Ed Hyman's article in Barron's a week or so back, and you know, you go around this country and you see Chicago, you see cranes, you see positive things going on, but he also raised an interesting point where there's a trend of millennials moving out of their parents' basement and doing household formation. So obviously, the next leg of this thing as we go together as a country, there are signs of growth out there. In the meantime, we have to continue to make the right allocation decisions within this overall complex. And, you know, short-term, intermediate, long-term, you diversify and you allocate, right? We try and make like we know what's going to happen in the future, but obviously we need to look at the facts that present themselves and make the best decisions we can possibly make. As we sit here in May in Chicago, it's raining and it's cloudy, but we're looking for sunnier skies on the horizon. In the meantime, until next time, thank you.